Get your tux on. We got a situation.
My name's Daniel. I'm a capital markets lawyer, which means I help people fill out forms so they can raise a bunch of money. Well, not exactly people, but people acting on behalf of corporations. A corporate lawyer. Fun times. You know, when I go to parties and people ask me what I do, I tell them I'm a lawyer and their eyes just light up thinking about suits or something. And then I tell them all I do is push paper around for rich people, and the disappointment returns in their eyes. It's beautiful. I mean, I can package it in a way where, you know, I work on billion-dollar deals for the largest companies in the world. But that's kind of like saying a YouTuber is a CEO of an independent production company that partners with multi-billion-dollar media companies. Technically true, but a bit misleading. At the end of the day, I'm just rambling in front of a camera here and doing fancy paperwork out there.
Or I'll pay someone else your money to do it for me.
But I want to explain exactly what capital markets or securities lawyers do and give an overview of everything I've learned so far in the industry. It's going to be very high level, very general, but not legal advice, not financial advice or life advice, not any kind of advice. You don't want to get advice from me, okay? So what are capital markets? Let's say you have a great idea. Maybe you invented an app that reminds you to keep eye contact in conversation so people don't think you're weird. Or maybe you run a government and need money to build a very large highway. You have aspirations, but what you don't have is money. So you go to the capital markets, which are basically a giant, highly regulated matchmaking service where companies and governments sell little pieces of themselves. Sad, but these are stocks and bonds to investors who have more money than they know what to do with. If all goes well, you get the cash now. And investors get some cash back and some more cash on top of it later on. It's an investment. Either this happens because, you know, your company thrives and you can pay back the bonds, the IOUs, or someone else is willing to buy those little pieces of the company that you sold, stocks, for more than they paid. If all does not go well, your company flops, investors lose the money, and a few years later, someone writes a book about you and WeWork files a Chapter 11 bankruptcy or something. I don't know. Either way, lawyers get paid.
I received confirmation of a wire transfer from escrow indicating payment in full.
Cash rules everything around me. Cream, get the money, dollar bill, y'all. Capital markets, if you break it down, they come in two flavors. The equity markets, stocks, where companies sell ownership slices known as shares in exchange for cash. And the debt markets, the bonds, where companies or governments sell IOUs that promise to pay back money later with interest on top. And you can also have primary markets and secondary markets. Primary is where new securities, the stocks or bonds, are sold for the first time, like an IPO or an initial public offering, which is basically a very expensive debut single for a company. And you have secondary markets where existing securities trade hands. Securities, remember, are stocks and bonds. These are things like the stock market, where people buy and sell shares based on, I don't know, who tweeted what that day. Here, you're not getting it directly from the company. It's someone else who bought it, maybe directly from the company or somebody else, and you're getting that secondhand. It's all very exciting, sometimes terrifying, always complicated, and that's where lawyers come in.
Enjoy your evening, Donald.
I like to think of capital markets as a playground with rules. They're a very heavily refereed sport where referees, the regulators, the government institutions, occasionally change rules in the middle of the game. Here are the main players, the enforcers, the writers of the rules. First, the SEC, Securities and Exchange Commission.
What does the SEC have to do with climate, and why?
The most important innovations in our capital markets came along during the Great Depression, when we began requiring public disclosure of important information from companies that wanted to raise money from us. The basic bargain is this: investors get to decide what risks they wish to take. Companies now, that are raising money from us, have an obligation to share information with investors on a regular basis. Now, the first disclosures, those revolved around companies' financial performance.
They were established in the US after the Great Depression, when people realized that maybe stock market fraud was bad. They essentially review offering documents, write rules, and sue people who commit securities fraud. FINRA, the financial industry, regulatory authority. Don't ask me why they added the N in an acronym, but they oversee broker-dealers like investment banks. They make sure underwriters aren't overcharging issuers, and they regulate research analysts and prevent them from hyping stocks that, they secretly think are awful. We'll get into the main players a bit more later. But moving on to other laws, there's state laws or blue sky laws. Every state in the US has its own security laws, but most big deals avoid them through federal preemption, meaning the federal laws come out on top. So who cares about these state laws? But if you're doing private placements, you may need to file paperwork in multiple states. Lawyers handle this, junior associates suffer through this. Cycle continues. Sarbanes-Oxley's or SOX. It was passed after Enron and WorldCom, and it made it much harder for executives to pretend that their companies were fine when they really weren't. It requires CEOs to personally certify financial statements, which really makes them nervous. Dodd-Frank's, that was passed after the 2008 financial crisis, mostly affects banks. It includes other sub-rules like the Volcker Rule, and it basically tells banks, hey, maybe don't gamble with depositor money. The Jobs Act. The Jobs Act, it makes it easier for startups to go public by letting them skip some regulatory requirements and file IPO, initial public offering, paperwork confidentially. So if they, change their mind midway, nobody knows. And it also made it legal to advertise private investment deals, which led to many interesting scams. Now, stock exchanges have their own rule books, like requiring certain corporate governance standards for listing companies. They have a huge manual, very boring stuff. You also might come across the CFTC, the Commodities and Futures Trading Commissions. This is for derivative products, and it's more peripheral to capital markets lawyers, unless you deal specifically with swaps and stuff like that. Okay, as you might see, there's a lot of rules and too many to keep track of. It's like one of those complicated parking signs. It'd be really great if somebody could just give you an answer, or better yet, just park your car for you. And that guy is the lawyer.
You gave him up to save your own ass.
That's a lie.
Doesn't matter, they'll think it anyway. But hey, that's just one man's opinion.
When you're doing capital markets deals, lawyers aren't the main character. They're the annoying side characters, always saying we can't do that to the main characters, and they usually get killed off because nobody likes them. The main character of the capital markets deals are probably the issuer, the companies themselves, or governments in some cases that need the money and are raising the money, and they're the ones issuing the securities. They want this to be as quick and painless as possible, but it never is. And every story needs a little drama, The underwriters are another major character. The investment banks, the Wall Street firms, the Goldmans, the Morgans, and the Stanleys, and how have you. They help issuers sell securities. They price the deal, they find buyers, they often guarantee the issuer a certain amount of money, and they charge fees for this because, of course, they do. And you have the investors, the people with the money. Some are giant institutions, the hedge funds, the pension funds, the mutual funds. Some people are just regular people, the retail buyers. They hope to buy low and sell high. In my case, I just buy high. Finally, we have the regulators, the referees. We mentioned some like the SEC, the Securities Exchange Commission in the US, major player. They make sure that everything is fair-ish. Also, FINRA, we mentioned that they police brokers, and you have state regulators, and they bring their own flavor of bureaucracy, which is always a joy.
Nothing's wrong. I need a glass of water.
What the hell is going on?
Now again, lawyers are the ones who make sure all the characters play by the rules. They draft disclosure documents, basically a very long explanation of why you should trust the issuer or the company with your money. They review financial statements, along with the auditors. We'll get into more detail there. And they ensure that essentially no one goes to jail. The system works most of the time. Now, capital markets are where companies go to raise money, where investors go to try to make money, and where lawyers go to make sure it's all done in a legal way. The whole system is a balancing act. It makes it easy enough to raise capital so companies can grow, but not so easy that investors get scammed.
So I'm going to give you the benefit of the doubt that you didn't know.
But as long as you tell people honestly about what they're buying, be transparent, disclose, the regulators are apparently okay with it. So lawyers are all about telling investors about the company that they're buying. Of course, the lawyers also do some other stuff like drafting deal documents according to the rules, the business decisions, and solving whatever other problems that come up. Like, I don't know, the company CEO posting stupid stuff on Twitter or X, and smoking pot on Joe Rogan's podcast.
Civil liability associated with agency is based on several factors,
including the deviation of the agent from his path.
Wait, so what are capital markets again? Okay, let's take a step back here and take a look at the world of finance from the perspective of investment banking finance bros. The finance world is all about risk. Well, also money, but anytime you try to make more money, you take on risk. Now, when a company tries to sell its securities, they want to get the best price, make sure that they sell it all and do it so pretty quickly. But these companies don't know who to sell these stocks or bonds to for the best price and don't really know how any of this works. So the bankers see this as an opportunity to get paid.
First year or any year, you just don't have a life.
Investment bankers are kind of like the fixtures of the money world. They're not the kind of banks that you deposit money into, and they're the banks that, help the largest companies solve their money problems. How do I get people to buy stocks in my company? Where should I put my money so I get more money? How do I repackage my dope so that it looks higher quality? Sorry, not dope, but collateralized debt obligations, which also sounds just as suspect, doesn't it? So they come in and say, we'll buy your stocks or bonds, all of it, but at a small discount. Sign this and we'll give you the money without any hassle. The thing that they sign is called a underwriting agreement, which is a contract laying out how all this works. Banks are generally scared of big purchases like buying all the stock or bonds of a single company outright. What if they can't sell it right away? What if something goes horribly wrong with the company? A lot of Wall Street is about catastrophizing and convincing people to pay money for it. So the bankers bring in their banker friends to invest with them. Safety in numbers, right? Each bank invests less, and if something goes wrong, then it's not as big a deal. This is called a syndicate. The syndicate is a group of these banks, and they share the pie of buying the company's stock or bonds in different ways. Usually, bigger the pie that you buy, the more say you have in how the deal runs. There's also popularity contests among banks running in the background called league tables. So the bank in charge, the lead underwriter, often gets the biggest cut, and they get better deals, and they get to have their name in big on the first line and on the very left of the prospectus cover, which apparently is a big deal.
And I get it. I'm not good enough. What I don't get, Mike, is why you didn't have the courage to just come and tell me that yourself.
But sometimes it pays off just to tag on to a deal, even if it's not the most profitable, just to go up the league table. Each bank in the syndicate gets a portion of the deal, and it's responsible for selling these securities to its own clients. This way, no single bank is stuck with too much unsold stock if things go sideways. It's like a buffet where each bank takes what it can handle.
What?
I'm a fraud.
Now, lawyers are bad at math, so bankers do all the math stuff. especially when it comes to pricing the deal. So how much should these stocks or bonds be sold for, or how much are they worth? They analyze market trends, run fancy models, and then they tell the company what price they think investors will pay for it. If the stocks are new, like in an IPO, or there's a new bond, then bankers have to set these prices. It's a balancing game here. They want a high price to keep the company happy because that's what the company wants, but they also want it low enough so that other people will buy it. A big part of this job is finding people to buy it, which is called building a book. They go to hedge funds, other rich people, other banks, and anybody who has a pile of cash they want to use to invest. They also negotiate amongst themselves who's top dog and who can do what. And then they send the lawyers in to translate all of this into a contract. Again, the underwriting agreement. This is the main document that spells out everything. And it's hotly contested, which means that it's the lawyer's job to reflect any changes by the parties and put that in the agreement in writing. It lays out, who's going to do what, who's taking what risks, and who's getting paid. By the way, the underwriting agreement is between the banks and the company. So both the banks and the company have their own lawyers. There's a bunch of stuff that goes into this agreement because contracts are usually used as a tool to plan and distribute risk. It details what happens for every catastrophe you can think of. It's outlining, what the parties represent, meaning what they promise. For example, they're following all the rules, have the money, or promising not to do anything bad. Now, when it comes to underwriting, there's two main types. There's a firm commitment where a bank buys all the securities from the company and then tries to resell them. If they can't sell them, tough luck. The banks are on the hook for it anyway. This is the standard deal because companies want certainty and they want their money. And they're paying these bankers a pretty high fee. Another type of underwriting deal is called best efforts. Banks usually try to sell the securities, but they don't want to guarantee anything. So if nobody wants to buy, the company's out of luck. This happens in riskier deals where investment banks don't want to take on too much exposure and be stuck with stocks at the end of the day.
We're using the timing of our client's contract expiration to try to shake us down.
The banker's job is to sell the securities so that you can make a bit of profit off it. It's a story as old as time. It's like buying a large number of hats and knickknacks from a manufacturer and reselling them at a higher price for profit to convenience stores around Ontario, which is what my dad did to help us survive when we first came to Canada. There's also a bunch of stuff that bankers send lawyers to do. A big compliance thing is the prospectus, which is a document outlining all the details of the stocks or bonds that are going out, as well as details about the company itself. This goes out to all the investors so they know exactly what they're buying when they're buying a piece of that company. Remember, there's a lot of stupid forms and rules that you have to follow. So usually the most junior lawyer has to do all this grunt work. Some fresh law school grad is literally pulling up the forms of the prospectus and the rules like, Regulation SK, the business and operation information, as well as Regulation SX, which concerns financial statements, and checking that they meet all of these guidelines to the rules in what's called a form check.
I didn't think I was getting an office.
There's some other things in the underwriting agreement that parties use to distribute risk that needs to be completed before the deal closes. Legal risk is given to the lawyers in the form of legal opinions in what's called a negative assurance letter. They essentially make sure that the lawyers are kind of an insurance policy, the person to blame if anything goes wrong in the legal stuff. These letters or opinions state that generally there's no legal issues for various parts of the deal. Often it's specified. It says something like the company is following all the laws and the other contracts they have are fine generally.
So the rookie called in the veteran.
No, I'm just here to watch.
There's also the accounting risk and whether the financials are accurate as they claim, which is encapsulated in what's called a comfort letter. The companies, they bring in an accountant for checking all their financials and getting this comfort letter. It's kind of like a comfort blanket, but the accounting firm just says that they've checked all the numbers and it looks good.
You're in.
There's also business risks about what the company claims and the officers of the company sign. So there's a lot of certificates saying that, hey, what this company claims, I as an executive of the company, is true. So that way it's kind of easier to sue the company if they're lying. They can also get other risks of specialty areas. So like mining, you might get engineers or environmental experts to provide reports. This is all part of the due diligence process so that if you get sued, you know exactly who to blame. Again, these are ways of managing all the different risks in a deal. And what the lawyers arrange is the formalization of this into writing. Again, lawyers are professional catastrophizers.
This isn't elementary school. This is hard work, long hours, high pressure. I need a grown goddamn man.
Okay, so everything seems straightforward so far, haha. But there's some areas of more drama, and it's mainly because everybody's looking out for themselves and trying to maximize what they can get out of a deal. Welcome to capitalism. For example, remember when I mentioned banks sometimes need to set a price for the first time a company issues shares in an IPO? Well, banks talk to investors, they look at demand and try to keep the company happy with the price, but sometimes they underprice the shares on purpose so that there's a pop in the price and it makes the bankers look like studs.
Well, I'm not going to let that be the reason that Jenny and I don't.
Now, the green shoes or over allotment options are also another neat little trick by bankers. When they are outselling stocks or bonds, they often sell more shares than actually exist. They sell something that they don't own. It's called a naked short. But because it's done with fancy contracts, totally legal. Now, if the stock price goes up after an IPO, the banks just issue extra shares. Because of this option, they were allowed to sell them from the beginning, and they make out with a clean profit. If the stock tanks, they buy shares at a lower price, and they pocket the difference. It also helps stocks stabilize temporarily since it looks like there's demand in the market from this artificial purchase. Either way, the house always wins. It's price manipulation, but it's legal because, I don't know, the government said so. Now, bankers going out to sell the stocks and bonds on their little marketing roadshow is when they fly around to meet with hedge funds, institutional investors, and pitch the stock like it's the next Amazon. The whole point, convince enough investors that this stock is the one, even if the company itself is a flaming pile of garbage wrapped in good branding. There are even cases where bankers guarantee allocations of stock to certain investors in exchange for favors down the line. It's not illegal, but it's not exactly fair either. And sometimes executives get a little too excited during these roadshows and say things they legally can't say. There's another point here where CEOs on these roadshows often brag to the public even before the deal closes. You're not allowed to do that. It's what's called gun jumping, and guess what? The lawyers get dragged in to clean up this mess too.
Dick kick. Dick kick.
Now, bankers, they act like they run the show, but who's really making sure they don't go to jail? The lawyers. The entire underwriting process is basically a game of who can take the risk and push it on to someone else. The lawyers are the ones making sure it's all documented in contracts, so nobody can claim that they didn't know what they were signing up for. By the way, lawyers get paid by the hour or on a billable hour basis, but banks, they get a fraction of the total deal price. In an IPO, sometimes bankers get up to 7%, which is insanely more than the lawyers are even charging, even if lawyers are charging thousands of dollars an hour. Now, companies hate spending this much money, but they can't raise money on their own, so they need lawyers and bankers. But this also leads companies to get their money's worth and have bankers and lawyers work 24/7 and be constantly available. For young capital markets lawyers, this is where you learn to coordinate big teams, track a million moving parts, and stay up all night fixing documents so that the deal closes without an issue. And if everything goes smoothly, sometimes the company and the banks give you a fancy closing dinner at a high-end restaurant. I don't usually get those. So, if you don't get those, there's always the next deal.
Watch your back in there, Mike. I will.
I refuse to answer that on the grounds that I don't want to.
Okay, let's look at IPOs. It's the financial world's equivalent of a Broadway debut or whatever hacky metaphor you want to make. Company that was once a scrappy private entity, maybe a startup with burning VC money, or maybe an old school family business. It suddenly becomes publicly traded. Its stocks are available to anyone with a brokerage account and an opinion. This is exciting, but it's a lot of work, which means it's a lot of money to pay a lot of people to do the work. There's paperwork, and where there's paperwork, there are lawyers.
Mike Ross for the plaintiff, Your Honor.
A. Elliot Stemple for the defense. What are you doing here?
There's also the investment bankers and expensive suits explaining why the stock should be priced slightly lower than the company wants. For the company, going public means raising capital, providing liquidity for investors and employees, and getting that coveted stock ticker symbol. But it also means regulatory headaches, quarterly earning pressures, and the joy of anonymous internet commenters speculating about your business strategy. There's good reasons to do an IPO. There's raising capital. You could get more money to expand, pay off debts, or just fill the bank accounts with billions of dollars because, seems like a good idea. There's liquidity for shareholders. Early investors and employees who want stock options might want to finally cash out, and this gives them a chance. There's public currency. There's a reputation. Once public, a company can use its shares to make acquisitions or attract talent with stock-based compensation. Again, there's the prestige element. It's a signal for legitimacy. Your company gets analyst coverage, a bigger profile, and maybe even a segment on CNBC.
Isn't there a metal briefcase full of bearer bonds handcuffed to your drinking arm?
Pretty sure you just answered your own question.
But there's downsides. There's regulations. Public companies file quarterly 10Qs and annual 10Ks and report to the SEC. Plus, they have to comply with all these other regulations like SOX and whatever governance rules. There's stock price pressures. The market wants growth. If quarterly earnings disappoint, investors will let you know by selling your stock. There's public scrutiny. Everything from executive pay to business decisions that get analyzed and criticized. Now, retail investors, they're very opinionated, especially on Reddit. This is why some companies delay going public and often instead opt for, venture capital or private equity funding. But eventually, many still opt for IPO status, for capital, liquidity, or just, they think it's the right time.
Take a swing and see what happens. I didn't think so.
Let's break it down. How and why does a company go public, and what actually happens in an IPO? I'll give you the lawyer side of things in more detail, and I'll show you what, what's arguably the most exciting part about being a capital markets lawyer.
Harvey, what's going on with you?
Nothing's wrong. I need a glass of water.
Okay, there's a few steps. First, you gotta assemble the team. The company hires the investment banks, the underwriters, they run the IPO process, they price the stock, they sell it to investors. Now, banks want to be on this deal to make money, so a lot of banks are kind of competing to be the bank that takes you public in what's called sort of a bake-off. Then you have the lawyers. The company has its own lawyers, issuers counsel, and then the banks have their own lawyers, underwriters counsel, and they ensure everything, follows securities laws and negotiates all the deal elements from the legal side.
To a zone, it's just one of danger.
You also have the auditors. Company need clean, audited financial statements. If they're not in good shape, an IPO could be delayed. The team starts off by a kickoff meeting. So all the parties, they get together, they discuss, how is this IPO going to be structured? What are we going to do about the sort of project management aspects of financial reporting, all the disclosure documents? Are there potential legal issues? And how are we going to frame the company's story for investors? After the kickoff call, you usually start diligence and writing the prospectus, which is the main document that goes out to investors that describes the company as well as the shares and stocks or whatever the initial public offering is offering. And it has to comply with the security law requirements. And there's also a lot of filings that go into it, an S1. But the real work starts with due diligence. Lawyers and bankers, they review everything about the company. The financials, the contracts, the legal risks, the intellectual property. The goal is to uncover any red flags before the investors do. Now, the prospectus, it's one component of a larger filing, the S1, the registration statement, which has to be filed with the SEC. And the basic elements are sort of the business overview, what the company does, the risk factors, a long list of what could go wrong, the use of proceeds, what the IPO money will be used for, the financial statements, the audited financial statements with footnotes that nobody really reads, and what the SEC demands in this S1 form is that companies are truthful. They're disclosing everything fully. And there's a bit of back and forth with the banks and the lawyers. And maybe the company as well. The lawyers want to make sure that the S1 is accurate. The bankers want to make sure that it's persuasive to investors. You kind of need to write the registration statement in a way that's compliant but persuasive. One way to do this is having the junior lawyer check every number and statement to tie out that it's legit, and by sort of blunting very ambitious statements like we're the best company ever. You want to change that to an opinion like we're one of the best companies in our opinion of the people in our industry, blah, blah, blah.
A giant hand has turned my dial from half-ass to quadruple ass.
Okay, the third part is you have a draft of the S1 or the registration statement, and then you send it off to the SEC. The SEC is going to come back with a bunch of comments because they're never happy with stuff. The SEC reviews it, they come back with comments and questions, and the lawyers and bankers and the company go back and discuss how to revise it. And then you amend it, file it again, and then this back and forth happens, multiple times over weeks and months until the SEC is satisfied. There's also strict rules on public statements. The company can't hype the stock before the SEC gives the approval. If the CEO accidentally says we're going public and we're going to crush the competition, that's gun jumping, which, again, could delay the deal.
It's not your shit.
Half of it is.
Because I had a shitty divorce lawyer.
Whose fault is that?
Now, the roadshow, what the bankers do to sell the stocks, the company's executives, the CEO and CFO, as well as the underwriters, go to meet big investors, mutual funds, hedge funds, and pension funds. They present why the company is worth investing in, and they take questions. Underwriters use this process to build a book and figure out who wants to buy the shares and at what price. Throughout the roadshow, this sort of demand is tracked, and if everyone wants the stock, they might increase the price. But if demand is weak, they might, lower the price or even delay the offering altogether.
You need me around because you want the excuse to be your worst self.
The night before trading starts, the underwriter and company do what's called a pricing. They set the final price per share based on the roadshow demand and the number of shares sold, sometimes more, sometimes less, and the allocation, which investors get how many shares. And the goal is ultimately to price it high enough to maximize the proceeds, but low enough that it ensures a stable debut. If the stock jumps too much in one day, it kind of suggests that maybe the company could have raised more money. The big day. Trading begins on the morning of the IPO.
Win toast?
It's 9 o'clock in the morning.
Yeah, and champagne is like the breakfast of alcohol.
Now, after the IPO, there's still work to be done. The company is now public. It's filing quarterly and annual reports now, so lots of money for the lawyers. And insiders, the founders, execs, and early investors are locked up for around 180 days before they can sell their stocks so that, it doesn't affect the trading. And if an IPO is successful, the company can raise more capital later on in follow-on offerings. Now, not every IPO works out. For example, in 2019, WeWork's IPO completely collapsed when investors saw its governance problems in the S1. Now, for the company, an IPO is a milestone moment. You only get once. Some CEOs only see this once in a lifetime. For the underwriters, it's a lucrative business. The banks made a ton of money on this deal. For the lawyers, it's just a ton of paperwork, man. But if you love your job as a securities lawyer or a capital markets lawyer, this is what you live for. The thrill of guiding a company into the public stage.
This will be good for our economy. It helps companies raise money. It will promote economic activity.
Then they're going to sue the state for breach of contract and seek to initiate eminent domain in federal court.
All those things seem likely.
No shit.
The lawyer's main job is to make sure that people don't get sued. Their clients don't get sued. Here's the thing about selling securities. You don't actually have to be a criminal to get in trouble. If you lie in your prospectus, you're liable. If you accidentally mislead investors, you're liable. If the company thought it was telling the truth, but it left out some crucial facts that later makes everyone very sad, liable. This is why capital markets law is not just about doing deals, but about surviving them. As a capital markets lawyer, you're not drafting contracts and just filling forms. You're a full-time catastrophe predictor. Your job is to imagine all the ways that things can go possibly wrong and then make sure that it doesn't. And your client is not the one getting sued.
I ain't judging you, buddy.
Good morning, gentlemen.
I'm hunting too.
Here's how it usually goes. An investor buys a stock or bond of a company hoping that, it makes a bunch of money. Instead, they lose a bunch of money. They look for someone to blame other than themselves, of course. So they say that the company misled them. They're a perfectly reasonable investor that read all the terms and services and forms and filings in great detail. But due to a tragic, malicious attack by the company, they were tricked into making this investment and losing all of their funds. that they work so hard for. So they sue. On what grounds? Well, the big one in the Securities Act of 1933 is Section 11, which governs IPOs and other securities offerings. Section 11 says that if there's a material misstatement or omission in a registration statement, which includes the prospectus, investors can sue pretty much everybody. The company, of course, because it sold the stock, the CEO and CFO because they signed the document, the board of directors because they were in charge, the underwriters because they helped sell the stock, the auditors because they vouched for the financials. The only people who don't get automatically sued are the lawyers. Not because they didn't help write the prospectus, but because they didn't, certify it. And it's not the lawyer's job to make sure that the company isn't lying. They double check all the figures to make sure that they're accurate according to the company's records, but they can't be 100% sure that the company records aren't fraudulent themselves. Also, there's really no money in suing lawyers since law firms don't have a lot of cash lying around relative to these big banks and companies, and law firms have their own insurance that really doesn't pay out much. So it's really not worth it. So sue the company, sue the banks, whatever. Good job.
What do you want?
To make a scene. You ready to watch that happen?
The company itself has no defense if the prospectus is wrong. Now, if the prospectus is wrong, if there's some fraud going on, the company has no defense. They're on the hook. But the underwriters, the directors, and the auditors, they usually have an escape route, the due diligence defense. If they can show that they conducted a reasonable investigation and had no reason to believe that the prospectus was false, then they're off the hook. That's why they hire capital markets lawyers to be extra paranoid and conduct due diligence on their behalf. In theory, due diligence, it's supposed to be this noble process, a careful, meticulous review of the company's business to ensure that everything in the prospectus is true and complete. In practice, due diligence is just a long, stressful grind where people don't trust each other and others pretend to trust each other while secretly taking notes in case they need to blame someone later.
Beth Dutton. I run mergers and acquisitions for Schwartz & Meyer.
The whole process begins with document review, which sounds boring because it is. The lawyers and bankers request every piece of paper that might contain relevant information about the company, financial statements, consumer contracts, board meeting minutes, regulatory filings, legal settlements, stock options for employees, internal policies, anything that could become evidence in a lawsuit.
It's the greatest concentration of wealth in the United States, not New York, not LA, right here.
Then comes management Q&A, or in these due diligence sessions or due diligence meetings. This is where lawyers and bankers sit down with the companies and its executives and ask them all kinds of uncomfortable questions.
Plenty of trouble if you know where to look.
Does the company have any undisclosed liabilities? Are there pending lawsuits that could sink the business? Is the biggest customer about to leave? Do you have enough money to pay our fees? This process is about gathering information, but it's also about reading the room. If executives hesitate, dodge questions, or suddenly develop amnesia when it comes to financial projections, that's a red flag. It's like dating. The bigger and more reputable the company, the more forgiving you're probably going to be. If it's broken, struggling, and has a 5'4" CEO, you're going to end that date then and there.
This is just fun.
Then there's expert opinions. There are fancy letters that create a paper trail that due diligence was completed. Companies' auditors, they provide a comfort letter which essentially says, we check the company's numbers and they seem fine. The lawyers issue opinion letters and 10b-5, which says, we read the prospectus and didn't notice any obvious lies. These aren't ironclad guarantees, but they are a legal cover. If something turns out to be false, the banks and executives can point to these letters and say, hey, look, we asked our experts that we paid a lot of money for to do our diligence, and they didn't see a problem. Now, in order for lawyers to give a legal opinion, you have to go through the whole diligence process. And a lot of what the junior lawyer does is the diligence. This starts by looking at the corporate profile of public information on the company, as well as its, past filings or whatever you can dig up online. Then you request all the documents for the company to provide, which is usually through a virtual data room, but sometimes you need to go to their offices in person. And then you review it all to make sure nothing is wrong with the company. Takes forever. Very boring stuff. And then you also help draft some of the questions for the Q&A sessions with the company that are really focused on kind of the legal stuff.
And you're fired.
Another huge and annoying task doing due diligence is on the S1, the registration statement and the prospectus itself. You know, that thing that says the stuff about the company and the shiny securities that they're selling. This form of diligence is called backup and comfort. Now, for backup, every fact in the prospectus has to match with the company's actual document. If a board meeting says that sales are down 40%, but the prospectus describes strong and consistent revenue growth, someone has a problem. Your job as a junior lawyer is to circle all of these statements and make sure that they match or back up with the company documents and flag anything that doesn't match. You do a similar thing with comfort or getting comfortable with the numbers in the document, not the factual stuff like in backup, but the numbers which the auditors focused on. And you would think that the auditors would do this, but apparently there's some legal judgment involved in circling numbers. Now, after you circle the numbers, you don't need to match it with the company's financial statements because that's the auditor's job and that's why you get a comfort letter. But you do need to be annoying and check that the auditors did their job and look at every number according to their auditing standards. The guideline is SAS 72.
I really like her.
All this diligence needs to happen and be mostly finished by the time the deal launches so that any craziness is caught before everybody moves forward with this deal. If this timeline is short, you're pulling some late nights as a junior lawyer. Other times for repeat deals or follow-on offerings, you just need to do bring down diligence, which is just looking at the new stuff that happened since the last time the deal happened and you did all that diligence from last time. Once the prospectus is finalized, the company goes public, the stock starts trading, everybody just breathes a sigh of relief until, of course, the stock drops 50% and the investors sue. At that point, the underwriters and executives need to prove that they did everything possible to check the accuracy of the disclosures. They need to dig up diligence checklists, their meeting notes, their comfort letters and opinions, and they'll say, hey, look, we did our best. We had no reason to think anything was false. Go blame the company. And if the lawyers did their job well, this diligence defense will work. If they haven't, well, most law firms also have litigation counsel.
Everything's for sale, buddy. How much?
Now, most of the time, nothing catastrophic happens. The company raises its money, the bankers collect their fees, the lawyers send their bills, and everyone moves on to the next deal. But every now and then, something does go wrong. A disclosure is misleading, a financial projection was wildly optimistic, or, the company's biggest supplier suddenly cancels his contract, CEO resigns the day before pricing. The entire business model turns out to be a fraud. And when that happens, the people who did their due diligence properly will be fine. The people who didn't will be in court.
It was a good speech. I like your style.
Capital markets isn't all about public markets. That's just the flashy part. If you're a company and you need money, you could do an IPO, go through months of SEC filings and investor roadshows and general scrutiny so strangers on Twitter can yell at your CEO. Or you could not do that. Instead, you could raise money quietly away from prying eyes and do private placements, alternative offerings. The backstage invite-only version of capital raising is where companies sell securities to a select group of investors and they avoid the whole IPO circus. This is in many ways a more appealing option, and it's growing now these days more than ever. There's less regulations, fewer fees, faster execution. The trade-off is that the securities aren't really tradable, at least not right away, and investors get less disclosure. But if you're a company that wants a bunch of cash without the headache of a full public offering, this might be the way to go. There's a lot of rules for selling in private as well. The big rule is 144A. Think of Rule 144A as a, legal loophole, or lawyers use the term safe harbor. They allow securities to be resold without going through SEC registration, as long as they're only sold to qualified institutional buyers, or QIBs, which is a fancy way of saying big financial institutions with a whole lot of money. So here's how it works. The company sells its securities privately to an investment bank. The investment bank immediately resells them to QIBs under Rule 144A. And because QIBs are sophisticated investors, which means that they can afford very expensive lawyers, they don't need the full SEC investor protection treatment, so they don't need all that disclosure. What you get here is companies can raise capital quickly without going through the full SEC registration process. It's particularly popular for high yield bonds or junk bonds, and for companies that aren't quite ready for a full IPO, but they want to tap institutional investors. Of course, this doesn't mean that you can just make stuff up. Issuers, they still have to prepare something like a prospectus and offering memorandum. And underwriters still do due diligence because no one wants to get sued, even by institutional investors. And for bond offerings, there's often registration rights agreements where the company promises to eventually register the bonds with the SEC so investors can trade them more easily. It's essentially like saying, hey, we'll make this public later, but for now, let's keep it between us. Now, if Rule 144 is for institutional investors, Regulation D or Reg D is for accredited investors, a club where hedge funds, private equity, and rich individuals, who have like $1 million in net worth or making like $200K a year, which isn't too high now, but it's for sophisticated people. The policy rationale is that, if you have money, you can sort of afford to lose money without causing, regulatory panic. And Reg D allows companies to raise an unlimited amount of money from these investors without having to register with the SEC. The most common flavors of Reg D offerings are Rule 106B. So here, you can't have any public advertising, but you can take money from up to 35 non-accredited investors. Although in practice, no one, hits 35 because, no one wants to break this rule. And then there's Rule 106C. You can advertise an offering, but you have to verify that every investor is actually accredited. Reg D is everywhere. Startups use Reg D to raise venture capital, hedge funds use it to raise money, and public companies use it for quick capital. Pipes. But we'll get to that in a second. Private investments and public opening. Now there's a catch. The securities that you sell under Reg D, they're restricted, meaning investors can't just flip them and sell them on Robinhood the next day. They either have to hold them for a while, usually around 6 months to a year, or find a way to sell them under Rule 144, which is different from Rule 144A. Securities law, sometimes it's designed to be confusing. Now, lawyers love using Reg D because it's relatively simple, but they also have to make sure that, no one accidentally advertises a 506B deal and investors are actually accredited. Companies also have to file a Form D, a quick notice to the SEC saying, hey, we raised money under Reg D, don't worry about us, don't come after us. Now, I mentioned PIPE, private investment in public equity. It's when a public company raises money privately. This sounds paradoxical. How can you be public and still sell stocks privately? But it makes sense if you think about it. A company needs cash quickly. Maybe they have an acquisition to fund, or they really want some money for some big project. And instead of doing a full public offering, a follow-on offering, or something like that, they sell shares directly to private investors like hedge funds or private equity firms. These shares initially, they're restricted, meaning they can't be sold right away, but the company usually agrees to register the shares later so that investors can freely trade them. A registration rights agreement. From the company's perspective, a PIPE is faster, cheaper than a public offering because, no roadshow, no SEC review, just a few big investors cutting checks. But because the investor is taking the risk of buying unregistered shares, they often demand a bit of a discount to the market price, or they want extra perks like warrants. For lawyers, PIPEs involve negotiating the security purchase agreement, ensuring that investors get the right registration rights, and making sure that everything is structured properly so that it doesn't accidentally trigger shareholder approvals or violate stock exchange regulations. If a company is already public and it meets certain requirements, it can set up a shelf registration, essentially pre-approving itself to raise capital whenever it wants. Think of it like a corporate line of credit for the public markets. The company files a registration with the SEC saying, we're going to sell securities sometime in the future, and the SEC declares it effective, meaning this company doesn't have to do a full review every time it wants to raise money. And then the company, when it actually wants cash, it pulls securities off this shelf and then sells them. This is useful for ATM or at the market offerings, where companies kind of dribble out shares into the market over time instead of dumping them all at once. Instead of pricing a big block of shares at a discount, an ATM lets companies sell small amounts to good market conditions, reducing the sort of risk of a pricing crash. Now, investors barely notice, the fluctuating stock price, and the company gets capital without market disruption of a big public offering. Legally, ATMs, they involve an agency agreement with a broker, similar to an underwriting agreement with less commitment. And the lawyers ensure that everything is disclosed properly and that investors aren't blindsided by a slow trickle of new shares hitting the market.
You have more experience. You connect points I don't even know to look for.
Okay, closing and different procedural elements. This is a good taste of sort of what the process and project management elements of being a lawyer is like. After, drafting, revising, and wondering if anyone actually reads, the risk factor section that you've been editing based on 20 other precedents, we arrive at the closing date, the grand finale of capital markets transactions. This is when the company finally gets its money, the investors get their securities, the bankers collect their fees, which is, after all, it's the real reason why we're here.
Just executed a huge pipe. We're going to Arba Southeast Asian Sugar Company.
It's chaotic. There's documents to be signed, wires to be sent, last minute fires to be put out, and the lawyers are the ones making sure nothing goes horribly wrong at the finish line. A few days before closing, the lawyers circulate the closing checklist, really detailed manifesto of everything that needs to be signed, filed, confirmed before the deal can actually close. Some of the main documents that are really common among all capital markets deals, you have the underwriting agreement or purchase agreement, the main contract that deals with, the main component of the deal. You have the legal opinion where, lawyers solemnly swear that the securities are legally issued, which is always a relief. In debt deals, you have an indenture. This is governed by another piece of regulation, the Trust Indenture Act, and it has key terms of the debt or the bonds. You have, often a base indenture and supplemental indentures for new series of debt, but we won't go into debt deals in much detail. You also have the comfort letter, where accountants provide assurance that the financials are, a complete disaster. The contents of the letter is just, we're independent accountants and the financials are in compliance with SEC requirements. They reviewed the interim and unaudited financials and give a sort of negative assurance about them. They list the changes after the latest financials in the registration statement, and they comment on the circle of numbers. They also give the cutoff date for the last date of review.
Then my suggestion is don't. Regulations are too unpredictable and are hampering the industry.
Everything that they cover is the registration statement along with filings incorporated by reference. Anything that's not comforted, you get like a CFO certificate, meaning the CFO signs off on it instead of the auditors. For whatever reason, the auditors couldn't match it to the financials, match whatever numbers to the financial statements.
$200 million, which placed its paper value at $400 total. NASDAQ have already confirmed they are ready.
You have other certificates by company officers certifying that, nothing material has imploded since pricing. You also have regulatory filings because, SEC loves paperwork. And you also have third-party approvals or consents because sometimes a deal needs permission from rating agencies, stock exchanges, or other parties. And throughout this process, the documents are collected, signed, and held in escrow, meaning signatures are locked up in this fictional legal vault and released once everyone confirms that all conditions are met. Then on closing day, there's a formal closing call where lawyers from all sides and all parties dial in and they confirm that all conditions of the agreement are satisfied, the funds are in place, and that signatures can be released. Sometimes this is done by email. And all of this, there's a strict schedule for it.
For just long enough to take our personnel and our capital. All of it.
Now, the timing here matters. There's a concept of T plus 1, T plus 2, and T plus X. It refers to how many business days have passed between the trading date and the final settlement. The gap between when the securities are priced and when the money actually changes hands. It used to be generally T plus 3 because once upon a time, people literally mailed paper stock certificates. Then it became T plus 2 because technology improved. And as of 2024, we're moving towards T plus 1 because, apparently lawyers don't need sleep. For IPOs, the stock starts trading on T, but the company doesn't actually get paid until T plus 2 or, soon T plus 1.
It prevents us both from operating at our full potential.
There's a brief but nerve-wracking period where the underwriters have already sold the stock, but the money hasn't been delivered. To cover the risk, the underwriting agreement have material adverse change clauses, which allow the bank to back out if something terrible happens before closing. It's a clause no one ever expects to invoke, but it's just in case, company headquarters burned down the day after pricing and, the world ends.
This is an order outlining which materials I expect to be turned over immediately.
For investment grade debt, pricing and closing can happen on the same day or the next day because institutional bond buyers tend to be ready to fund immediately. The faster the closing cycle, the less time for things to go wrong, which is why, in theory, lawyers are supposed to love T plus 1, but only in theory.
Okay. Fine.
Even the most carefully planned closings can go sideways in unexpected ways. Common pitfalls include key executives suddenly being unreachable for signatures. This is why we get signatures in advance, but even then, you're often chasing them down for signatures, even if you have DocuSign or digital signatures. Just crazy things can happen. Hurricanes shutting down New York, but we can, close remotely now, or find an excuse to delay the transaction. Wire transfers can get held up, which can be solved pretty straightforwardly, but there's a lot of stress involved in these mild disasters.
My investment is entirely contingent upon you making this problem disappear.
The best way to handle solving these crises is to have a backup plan before the crisis happens. So when the CFO's plane gets delayed, someone already has the power of attorney to sign on their behalf. And then with the same amount of drama as, flipping a light switch, the deal closes. The issuers get the cash via wire transfer. The investors get their securities electronically delivered through DTC, the Depository Trust Company, the plumbing system of Wall Street. And immediately after closing, regulatory filing needs to be made. The final prospective filing on Form 424B, the last official version of the prospectus, updated with final pricing details and expected to be filed with the SEC within 2 business days. The Exchange Act registration, the Form 8A, if it's an IPO, the company also has to register its stock under the Exchange Act so that it becomes a full-fledged public company.
One man. A man so corrosive, so virulently
Otherwise, NYSE and NASDAQ won't let them trade on their exchanges. Stock exchanges, they also have their own paperwork. The issuer's lawyer usually coordinates with the exchange to confirm that the stock is legally issued and that it meets all listing conditions. Once it's done, the exchange officially lists the stock and the company gets a nice press release announcing its public debut. For companies that weren't public before, closing is just the beginning. I mentioned before, they have to do the quarterly earnings. They have to abide by the compliance of SOX and Dodd-Frank's. But there's also the constant threat of, shareholder lawsuits.
As much as I can trust anyone with my name and my money, I trust you.
And once the deal actually closes, the securities are out in the world being traded. The company has its cash. The bankers have their fees. The lawyers get paid their billable hours.
If you didn't trust me, why did you want me working for you?
Because I thought our goals were aligned, and I still think they can be.
For the capital markets lawyer, it's a strangely satisfying moment. The deals are a marathon of late nights, endless document drafts, and regulatory hurdles, and closing is the moment when everything just comes together. Of course, in the real world, as soon as one deal closes, another one begins, or maybe you're working on another one at the same time. Usually I'm on multiple deals. For the bankers, they start pitching their next transaction. Lawyers, they start reviewing their next term sheets. But at least for a brief moment, there's a small window to exhale. Maybe even leave the office before midnight.
Doing this not just for a living, not just to keep your name strong in the business, but to feel alive.